officially live on YouTube for the JWB
Week.
I am your host, Pablo Gonzalez. This is the Not Your Average Investor Show. And this guy over here is the guy that I call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Little chipper Greg over here. And with us back in studio, we missed her so much.
We did.
We call her MTM because she brings us the moments that matter. And because she's Madison, the magnificent, your community manager. Say hello, Madison.
Hello, everybody.
All right. And man, I love seeing people rolling in here for the POT dubs.
Yeah.
If you're watching live on Facebook, or if you're watching live on YouTube or Facebook, because we kind of simulcast a little bit of both.
Sure.
Just go to nyais.com. Sign up there. You can jump straight into the show right now, or just put a calendar reminder on your calendar so it tells you on Tuesdays and Thursdays, and you can see us laughing at each other live in person while making a friend with people in the chat, because we do this live and then we repurpose the podcast and YouTube, and we always start with what, GC?
The roll call, baby.
The roll call. All right, we got Madison already in the house, welcoming everybody. We got Lee Bishop, the MVP of the Not Your Average Investor Show community, saying good afternoon. We got the Not Your Average Guest. If you jumped in from your text, then your name shows up as Not Your Average Guest. You can change that in the settings and put your own name so I know who I'm talking about. But I'm going to say, somebody says, hello, JWB fam. That could be Pedro. He says fam sometimes. I don't know.
Could be Pedro.
It could be Pedro. All right, we got Leslie Wilson from Denver in the house. We got our usual leadoff batter, John Henning, saying good afternoon. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
Checking in, good morning from the Bay Area. Let's rock. We got Michael Santorios from Chantilly, Virginia. I like that. That reminds me of that Chantilly lace and a birthday face. All right, cool.
What you doing there?
What's this? It's a song. All right, cool.
Sure.
Bill Green from the mountains of Colorado is back in the house. Good to have you. We got another great Not Your Average guest saying good morning. We got the ringmaster, Drew Barnhill, saying good afternoon. I was wrong.
It was not Pedro.
We got my boy Pedro Nacianceno from Jersey checking in. Pedro, I heard you got some big news to share about it.
Yeah,
you got some big news.
Big ups to Pedro. New property under contract. Congratulations, my friend, as well as Leslie Wilson. Wanted to recognize Leslie.
Right. Leslie too.
And
one other person.
Well, there's one other person. Let's see if she's checking in.
Let's see if she's checking in. All right, who we got? We got Sam Shantier from Orlando. Sam, new name. Welcome to the community, Sam. Great to have you. We got a name that we all know. Stepping into the light is Aaron O'Neill.
Into the light.
Say it. Who else we got? We got the patriarch of the first family of the Not Your Average Investor Show, who I'm sure is with the matriarch as well. Ken and Carolyn Moline. We salute you. Who else we got? We got Sergio Prieto. Go Gators.
All right, go Gators.
What's up, everyone?
Big Gator recruit signed yesterday. I don't know if you heard this, but I know Sergio was fired up.
Big in name and in stature.
Yeah.
I've seen pictures.
Gay Lagway.
Yeah, big
Get his jersey.
Big boy. Bill Green saying, Leslie from Denver, we need to connect. I agree. Leslie and Bill, y'all should connect. We got a whole contingency in Denver. We got Bebe Carlos over there.
That's right.
Anyways, all right, cool. I love the roll call, but you know my favorite part?
I know what your favorite part is.
It's my favorite segment when Madison shares good news.
Hi, everybody. Well, I feel like I haven't done this in such a long time, and I did it last week, but it's so good to see everybody. I have some pretty cool news. So, little backstory. When I started working for JWB, the term vertically integrated was super new to me. And while it was a really cool idea to me that everything was one phone number, one-stop shop, I didn't really realize the value of it until I continued to see the value of it. One of the ways that I have seen the value is the data we've kept to show just how beneficial working with a vertically integrated company can be for you. So Pablo's favorite, the fly data, what is it?
The data flywheel.
Data flywheel, there it is. Something that we keep track of is how much rental income you guys have earned in each month. So super cool. Last month, in the month of November, all of our clients earned almost $4 million in rental income.
Hey, yo.
Just a month. We paid out $4 million to our clients.
Hey, yo. $4 million.
Hey-oh.
I like that.
Jesus. I'm glad I wasn't drinking something. I almost did a spit take on my
I
computer.
know your eyes just like popped out of your head there.
Wow. Wow.
So the coolest thing is we started this just kind of sharing this number of rents that we pay out to clients from the rental income. We started just sharing that internally years and years ago. And we get that email from our accounting team every single month. And it says, this month we were able to send out yada, yada, yada number to our clients. And I remember that number being 700,000. I remember that number crossing 1 million for the first time. And we were like, oh my goodness, look at what we're able to deliver for people consistently. And then 2 million and 3 million. And now we're about to cross 4 million. It's a lot of fun.
That's nuts, man. My company wants to grow up to be 1 month of rent for clients for JWB.
There we go.
That's man, I'm a little took the wind right out of myself. Wow, $4 million of rental income. That is rent collected in 1 month from the 4,700 properties that you all manage. And then you just take that money and you deliver it over to somebody's bank account every single month.
Yep. It's pretty awesome.
Must be nice. That's pretty impressive. You know what I call that?
What do you call that?
I call that good news. Thank you, Madison. That was awesome. All right, let's spotlight us here for everybody. Madison, you are off the hook. And before we get into our property, I think we got a little bit. Man, it's kind of breaking news. GC, what do you got something to share here?
We're gonna call it breaking the most breakingest news we can possibly share. / we already kind of shared it on Monday and on Tuesday, but it's so cool that we're gonna share it again. So for all of you who were there for the client only call on Monday, and then of course for our community here on Tuesday when we did the recap of the Jacksonville real estate market and economic outlook going into 2023. It was an awesome call. That call is just dedicated to preparing you to make wise choices with your money in an otherwise challenging economic landscape. But that wasn't the only cool thing that we did, right? We unveiled JWB's largest incentive package that we have ever offered, because the reality right now is this asset class is built to perform better than most alternatives out there. But we also recognize that there's a lot of noise out there, and it's hard to separate the facts from the noise when you've got, a lot of talking heads out there who, don't exactly know what they're talking about sometimes. So we thought this was an important time for us to lean in and support all of you and help you make a really great decision, which is to invest in rental properties right now, especially given the alternatives that we see and the lack of performance in other asset classes, if you think about the short run and the long run. So long story short, we are offering it's about $10,000 worth of incentives. And that might be a little bit more than $10,000 worth of incentive. It might be a little bit less depending on the property you choose. At the end of the day, you're going to walk away with a significant amount of capital in your bank account that you didn't have to spend. And so we're really excited about it. So call it about $10,000 worth of incentives. I'm going to just walk you through that right now. And are we showing that on the screen?
We're showing it, man. Lee put in the chat, show it, Pablo. We want to see it. And I was like, great call, Lee. That's why they call him the MVP.
That's why it's the MVP.
That's why it's the MVP.
So call it $10,000 in incentives. So what this is broken down is into seller concessions. So JWB is paying 2% seller concessions, which all that really means is you just take the purchase price of the home, multiply it times 2%, and that it comes out to roughly about a $5,500 value. That's money that otherwise you would literally bring to the closing table. You don't bring that money to the closing table. You just keep that in your pocket. And then we're going to waive your first tenant placement fee. All clients who buy properties with JWB, you'll always get charged a tenant placement fee because you want a tenant in your property, right? You want a resident in your property, but you don't have to pay one when you buy a property now through JWB with this incentive. So that's about a $1,500 value. And then lastly, we're going to be looking out for maintenance costs for you. Maintenance costs are a part of every investment, right? It's a part of owning this assets like this. But how cool will it be that when that happens, you don't have to pay the bill? JWB is picking up your first $3,000 of maintenance costs. We expect this to last years before you actually get a maintenance bill for those clients that take us up on this offer. And you got to put a property under contract by January 31st of 2023. And it's available for any and all properties. So I certainly hope you all take us up on this. And then I was just checking this week, we've already had 3 folks that have taken us up on this offer. And we just shared this, Monday, Tuesday.
Yeah.
So Leslie and Gary and Rosalind Riley.
Yeah. Regular Rosalind Riley and Gary.
Regular and Pedro. So thank you all so much for putting your trust in us. I just think you guys made a great decision. I hope you all, seriously consider this. This is pretty special.
Yeah, pretty special indeed, man. And I love the fact that the community was the first ones to like jump in.
Yeah.
Right? Like we just so everybody knows, we're keeping score out here of like how many properties our community buys versus everybody else in the JWB ecosystem.
You would expect that, right?
Yeah.
That we're data nerds, right?
We're keeping score out here. So far, we're 3 for 3. To me, it's like the value of like being an educated consumer, being a part of this community and knowing, like when something is go time, right? Like I credit my rental portfolio for that, right? Like the idea that I got to be here, I got to listen to Rich talk about the deal being in the debt. I got to listen to you talking about quantitative easing is going away, and I was able to make the right decisions for me. And that is from the beginning, the vision of this thing, right? Like other people like me that need that education, they need that extra little bit of assurance and need to be, need to have their ear to the grindstone for like the moment to make the move that's going to change their financial future. So I'm just super pumped to see that happened. And yeah, man, I'm excited for it.
Love keeping it in the family, keep it in the community. It's even better.
Keep it in the community. All right. Speaking of keeping it in the community, we're going to talk about today exactly how this incentive package affects your returns in our POT dub, our property of the week. You ready to go to it, GC? I
am so ready to hear you pronounce this name of this property.
We are magically going to whisk ourselves away to 5154 Susquehanna Street, Jacksonville, Florida, 32254. Little side thing. I realized today that the way that I pronounce these addresses is becoming a thing. So I'm going to lean into it. Yeah. I got 3 data points from like walking up like, oh, I can't wait for it to hear you.
You haven't been leaning into this? You literally turned the last one into the Ricola chat. What is this new leaning into it that you're going to do?
Oh man, I'm going to lean into it. And Susquehanna, I'm going to lean into it. So, all right, key property details, purchase price of $225,000, monthly rent of $1,415. It's a 3-bedroom, 2-bathroom, 1,230 square foot house. Construction status finished. It's rented for 3 years because JWB only signs above or whatever. You go for 3-year leases, unlike anybody else in the property management game. Annual appreciation rate, the category best that you get here in Jacksonville, 4.6%. And when you add the incentive package and all this wonderful goodness,
look at that,
you get this ridiculous IRR of 14.7%. Dios mío, man. GC, a lot. I got to ask, what do you love about this property?
Gosh, there is so much to love about this property. I mean, how much time do we have? I could do like a 3-hour session just on how much I love this property.
I feel like we're not going to be able to clip this. It's just going to be the whole call.
So much that I love about this property. We'll try to condense it. But the first thing and the overwhelming kind of takeaway that I wanted everybody to leave from the client-only call and from the housing update and the economic outlook is that, listen, we are going into a recession, right? You ask the experts across the economic landscape and people know we're going into a recession. And so you can prepare yourself right now to make smart decisions with your money, knowing that we're going into a recession, and there's a game plan for doing that. And so I kind of shared that game plan with everybody. Number one, what you should be doing is you should be looking to turn equity into income, because when you go into a recession, right, people lose their jobs, right? Businesses, either close or earn less money, right? There's less money out there in the economy, and you want to be in a position of strength. And one of the ways you are in a position of strength is about the income that's coming in on a monthly basis. It's not necessarily what that number is of your stock portfolio. That doesn't give you a whole lot of strength at that moment. What does is how much money can I count on coming into my bank account each and every single month? So I think turning equity into income is a really solid strategy for you. Obviously, this rental property is one way you could do that. If you have a few $100,000 in the stock market right now, and you just have that sitting there, and maybe that's a significant portion of your overall wealth, and you're like, gosh, I don't know what the market's going to do, what the stock market's going to do going into the recession. You have the opportunity to take that money over there. Don't just be a sitting duck over there, right? Turn that into income. That could be an income stream of, call it $1,000 a month or $1,200 a month by buying a property just like this. And there's a lot of other ways to turn equity into income. So that's the first thing. The next thing to focus on is capital preservation. Let's face it, guys, odds are that when you go into a recession, the stock market does not perform well. 7 out of the last 11 recessions, the stock market has lost value. Stock market's lost value here, but we haven't even gotten to the recession yet. So stock market's not a place to preserve capital. Rental properties, absolutely a way that you can preserve capital. And that's what I would be focusing on, capital preservation. And number 3, you need to beat inflation, right? It's easy to keep the score when you're beating inflation, right? You measure inflation, or at least the government does, through what's called the consumer price index. And right now that's 7.7%. That means that for the same basket of goods, prices rose almost 8% year over year. So if your investments aren't earning at least, call it 8% or more, you're actually losing money. Might be pulling money into your bank account, but you're losing buying power. That's really what you're losing. Your goal is here as an investor is to gain more buying power. So when you see an investment that's 14.7% as an IRR in an environment where CPI is so high, other people just struggle to beat inflation. When you see something like this that does not require outsized risk, you don't have to bet the farm to earn almost a 15% IRR. You should take notice. I think it's a great investment for you. So those are the 3 things: turn equity into income, capital preservation, and beat inflation in a recession. And the reason that I love this property more than anything is because it checks those boxes. And there's not a lot of things that do at this moment.
And it's checking those boxes with an extra 10K check, which is pretty nice, man. I like this new language of yours, man. Lee has encouraged me. He just puts capital preservation as a new one I'm gonna be using. I like the languaging of things, because if you can define the problem, you will be known to have the solution. Right. And I think that's the best way to help people, is not to tell them that you have a solution for them, but to really make the problem be tangible and have them understand that you understand it. Yeah. Right. So like, I like this idea of equity into income is something I never thought about, and capital preservation as a way to talk to my dad about it over the holidays. Right. Because I've been hammering him, right? Like I've been trying to talk to him. He's come over the line of just being like, yeah, you're right with what you did, but he's still not at the point where it's like, this is what I should do because I'm 78 and blah, 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 blah. Yeah. And I think that conversation is going to be really, really interesting. This idea of just like, well, Dad, but right now you have all this equity. Why don't you turn it into income instead of just, and also preserve your capital? Like, don't you think you're about to go for a ride? The equity that you have that's producing income is going to go down. Why don't you just turn this equity into income and preserve your capital at the same time? I think is a verbiage I'm going to test over the Christmas lechon.
Man, that's awesome. I'm excited to hear about it.
Yeah, man. Me too. I hadn't really put it all together, but yeah, man. Well, all right, GC. I think that today's a really good day to dive back into the spreadsheet. Yeah. And just show how these incentives are really just kind of carrying through. I know that you got another concept that you told me about today that kind of blew my mind.
Well, I don't know exactly what you're talking about, but I'm sure that we will jump into that in just a second. What are you referring to exactly there, Pablo?
I'm talking about like a new strategy of leverage that you're talking about. Do we want to hop into that right now, or where do we want to go?
For sure. All right. So
start explaining it.
Yeah, absolutely. So, man, I think it was a friend named Randall on the call on Tuesday. I hope Randall's watching here as well. But when we were ending the call on Tuesday, he said, what are your thoughts on what interest rates are going to be in 5 years? And what he was getting to is like, I think interest rates are probably going to be lower sometime over the next 5 years. Would it make sense to do what's called an ARM? An ARM is an adjustable rate mortgage. Would it make sense? And I was like, man, that is so great, because we're going to be talking about this right now. I think when most people hear the term adjustable rate mortgage, they're like, oh goodness, let me take a step back. And it kind of creates fear for people, right? Like adjustable rate mortgages were a big part of what happened in the 2008 in the Great Recession and the housing, decline and all that good stuff. So, people are like concerned about that. And then people also think, well, if something's adjustable, then I have to like think more about this, more management. I don't want to do it. Right. And I totally get all of that. But there are certain times when an adjustable rate mortgage might make a lot of sense. And when interest rates are high like they are today, and there's a good chance that at some point in the not too distant future, they might be significantly less, the value that you get by actually looking into an adjustable rate mortgage is substantial in terms of a lower interest rate today. And then you still have flexibility over time to be able to make sure that you're not setting yourself up for failure. And so there are ways to do this in a risk mitigated fashion. And so this is something that we looked at over the last week or two. Lots changed in the mortgage market over the last week or two. And really over the last week or two, these types of adjustable rate mortgages, I think, make a lot of sense. So with the property evaluations that we're putting in front of you now, this is assuming that you're going to be doing what's called a 7-1 ARM or a 7-6 ARM. We can talk about the difference there in just a second. But what that really means is that your interest rate immediately is going to be lower than what you would get if you did a 30-year fixed rate mortgage. You're getting a clear savings right off the bat there. So for example, on the evaluation that you'll see here, and I don't think you need to go there yet,
Cool.
But
you see me frantically fiddling around.
I see you. Prior to this change and some of these incentives, your interest rate, I think, was about 6.5%, if I remember correctly. Your interest rate now on this evaluation is 5.5%, significantly decreased. And a part of that is because you're going with this 7-1 ARM loan product. So what is a 7-1 ARM? That means that for the first 7 years of ownership, that interest rate is fixed. So that 5.5% rate that you have on the evaluation, if you choose to go with a 7-1 ARM, like we would suggest, 7 years, you don't have to worry about the interest rate changing. At any point over those 7 years, if interest rates are lower than what they are today, if they're lower than 5.5%, you can refinance out of that loan into the same or lower interest rate going forward. And then let's just say that you make the choice not to do that, right? You're still holding on to the property because everybody here wants to hold on to properties over the long haul because that's how you win. But let's just say that you don't refinance between now and the 7-year mark. At that point, the rate would adjust, and the rate adjusts either every 6 months or every 12 months. And it adjusts to a rate that there's a formula for it. It used to be based on something called LIBOR. They don't base it on LIBOR anymore. It's basically just a rate that is a fixed rate. And then there's an interest rate adjustment on top of that. So anyways, your rate adjusts. It could adjust up higher than 5.5% in the future. It could adjust lower than 5%, 5.5% in the future, but there is that adjustable rate, equation. But at the end of the day, we're here to produce the best risk-adjusted returns on investment for you. And so when we run the numbers and we talk about the interest rate savings that you have right off the bat, plus any additional refinance cost that you have down the road, it's a clear decision that this actual loan product makes a lot of financial sense, actually produces a better return on investment. And so that's why we're going strong with recommending that. This is the first time we've recommended ARMs.
Yeah, man, I would like to dig into that a second. So what's different? Like when I hear adjustable rate mortgage, I immediately get triggered into Great Recession,
right?
Conversations, right? Like, why is it different today to get an adjustable, like in this deal? Why is it different than like when we were doing it during the Great Recession?
Great question. I'm glad you asked. So in the Great Recession, when people used ARMs, what they did was anybody and everybody who could, fog a mirror was basically given an ARM, an adjustable rate mortgage. The qualification process there, you didn't really have to submit a whole lot of documentation. So you could just basically make up whatever income you said. It was called stated income. Stated income. Like, you don't really have to supply documentation. You just state whatever your income is. So that's one problem. The next problem was that with those adjustable rate mortgages, you were qualified based on what the initial introductory rate was. So in order to get these people qualified with their stated income, it only had to measure up for like these introductory teaser rates. So they would artificially put these very low introductory teaser rates for like 1% or 2% or 3%. interest rates. And that would be, let's say, for the first 3 years, whatever. Well, to qualify people for those really low interest rates, they only had to qualify for that payment based at 1% or 2% or 3% or whatever I'm saying here. That is not the way it is now. So because of a lot of the regulation that came from the Great Recession, these adjustable rate mortgages were standardized and much more highly regulated. And so with an adjustable rate mortgage today, you still have to qualify based on what the rate will be once. First of all, there's no teaser rate on this loan, but even if there was, you would have to qualify based on what the rate would be at once that teaser rate ended. So just because we hear adjustable rate mortgages today, don't equate that with bad loans that are given. It is basically the same type of qualification as if it was a standard fixed rate 30-year adjustable rate. Yep. Yeah, 30-year. I'm sorry. It was a standard 30-year adjustable. Let me start over. Standard 30-year fixed rate mortgage. So it's the same qualification. You're just basically taking the bet that I'm going to pay less in interest today, and I'm going to maybe have to refinance later on, but the qualifications are the same as if you were doing a 30-year fixed rate loan.
So that's at the system-wide level, right? Like why it's okay. I mean, I would say that is the banking system that's fixed itself so that there isn't people doing this en masse. What about on the personal level? Like why would I today take an ARM versus back then shouldn't have taken an ARM?
Well, the way I look at this is what are interest rates today and how likely is it in the future that interest rates are going to be lower sometime over the next 7 years. And I think when you look at interest rates today, they're high. I mean, geez, they've risen 4% roughly in the last 6-8 months. Yeah. So the chances that over the next 7 years, at some point, you would be able to refinance and lock in to a 30-year rate and profit from that decision is highly likely, in my opinion. It's a good bet to take, in my opinion.
Got it. Yeah, I mean, that's kind of what I was thinking when you first told me about it. It's like back then, I don't know what interest rates were in 2006 and 2007. Maybe you know, but like I also know that since then, we have become addicted to super low interest rates, right? Like I feel like this idea of like right now having 7%, 8% interest rates is so outrageous to everybody alive. Like everybody's forgotten that at some point it was like 12% or whatever.
Right.
And now we expect low interest rates in our economy to function that way. Therefore, all politicians and all people that are doing this are going to be pushing a downward pressure to go from these like 7-8% interest rates right now back down to that, like maybe not 2 or 3, but like maybe down to that like 5 or 4, very likely in the next 7 years, right?
Yeah. If you look historically, the interest rates that we have right now are much more normal.
That's what I was saying.
Than what we've been experiencing for the last 10 years.
Yeah.
So, and now we can get into some really big macro, topics if we want to think about what our economy is really, how it's really built to perform, right? We've had low interest rates for a significant amount of time now, and people have become accustomed to it. So it's hard to go back to your point. So
put the genie back in the bottle.
I mean, as soon as they raise interest rates like they have this year, as soon as the Fed has raised interest rates, what's everybody saying? This is not going to last. They're going to bring interest rates back down, right? The whole economy and definitely the stock market is just waiting for some sign that the Fed is going to bring interest rates back down. So there's an expectation that that's going to happen.
Yeah, correct. So I think that that's important to talk about, right? Like it does feel like a new normal is an economy that works off of low interest rates because we have become this society that relies on it, right? Like if not, things just don't work like they used to, and that leads to chaos. So I think we're going to be very incentivized to go that way.
Well, and again, listening to the Fed is important here. The Fed is already saying that we are going to raise interest rates in the short run, but eventually we do see, they're basically saying, don't expect interest rates to go down as quickly as you're thinking, but over time,
that's the goal.
That's what we will probably do.
Cool, man. All right. I say we pop open these spreadsheet because we got some specific questions about this property and how the incentive package plays. And I know that you thrive in those scenarios.
Sweet.
So, all right, Drew Barnhill, his question, the ringmaster, you may be familiar with him.
I am very familiar.
Is the spreadsheet, does the closing cost include the seller concessions?
It does include the seller concessions.
Where do we
yes.
see that, GC?
So if you go to the analysis conventional finance type and zoom on in there, my friend,
Where?
for those, well, just, up to the top and to the right, boom. Perfect. Estimated closing costs. Yeah. So estimating closing costs are now back to, geez, what's that? $5,600. If you looked at what our evaluations were, and you can do this, you can check me out, right? Go back to jwbinventory.com and go see previous weeks of the property of the week. You'll see that estimated closing costs were probably closer to $10,000 and $15,000, depending on which property it was. So that's where you see a significant decrease. And what's happening here is we're taking those 2% of seller concessions and we're buying down your rate for you. And so that's how we get, we use the 7-1 product, like we're talking about, the 7-1 arm, to get a lower rate already. And then we take those 2% of seller concessions and then we buy down that rate as much as we possibly can again. And that nets you with a 5.5% interest rate, whereas the rest of the world has to pay a lot more than 5.5% for a loan like this.
Got it. Is that we talk about this idea that you only doing business with mortgage lenders that can close this deal. And that also creates this kind of like advisory council of your like mortgage providers. Did y'all kind of run this past them? Did you kick this with them?
Yeah.
Did they bring it to you? What was the conversation like of this strategy and implementing it with them?
Combination of all of the above, right? We're just in constant communication with our lending team. I would say in normal environments, we always are, but definitely this year, right? If you want to think about the most sensitive thing right now, it's been interest rates. So whenever there is new news or a potential opportunity, our lending team lets us know. And we have those weekly calls regardless to ask those questions. But yeah, so for this one, even if you looked at, because we had been thinking about doing this for a while, but the difference in rate from a 7-1 ARM versus a 30-year fixed rate loan, there wasn't much of a difference in rate up to couple of weeks ago, because we were looking for this, and that's just the way that the market was analyzing the opportunity, right? So now that there is a spread and that we can get a lower interest rate simply by going to a 7-1 ARM, we think that's a good move. Whereas things changed a lot, and 2, 3, 4 weeks ago just wasn't the same.
Very cool. All right, Michael Santorios has a question. Greg, on the 2%, 5,500. Is that up to or a flat 5,500 concession? Today's $225,000 property times 2% would be $4,500 concession.
Great question, Michael. It is not up to, it is 2% of the sales price. So if it's a higher purchase price, as if it's $275,000 as a purchase price, then it would be a $5,500 value. For this property, which is priced at $225,000, just like you did the math right there, I think that's $4,500 if I remember correctly.
Where's that reflected here? Is that just kind of here in this closing cost, or?
Yeah, so it's not exactly clear and reflected specifically in here, but what's happening here is your estimated closing costs have gone way down from what they were previously, and your interest rate has also gone down. And so both of those, the only way that stuff happens is by somebody paying the bill for that, which is buying the rate down, which is what we've done.
Got it. Cool. Sam Shantier, our new attendee and hopefully future community member. Sam, good to have you.
All right.
Already chiming in, Sam. Those are the behaviors we like to see. Asking, the property square foot price is $182. Isn't this priced kind of high? What is so special about this property?
All right. Love it, Sam. Bring us some really good questions.
The heat, Sam.
Well, let's define what we would call special.
Okay.
Right? My idea of special is probably different than what most realtors would say as far as what makes this special.
Okay.
When I'm looking at special, I'm looking at internal rate of return. That's the first thing I'm looking at. Like, how much is my money going to be working for me each and every year? And I compare that to what my alternatives are. And right now, in the stock market, in the bond market, and most other asset classes, really hard to earn, call it a 15% return on investment, IRR, like we're talking about right here, without taking a whole lot of risk in one way, shape, or form, or without doing this yourself, like being active in that investment. So when you're able to look at a 15% return through this asset, I think that's really special. That's what makes this special. there's also 5 ways that you profit, that you earn income and growth from this asset class. And you really just don't get that in other asset classes. You know, those 5 ways are net rental income. You get tax savings, you get principal pay down, you get home price appreciation, you get inflation hedging as well. So those are the things that makes this special to me. Overall, I think what you're asking about is just like market value, right? You know, and price per square foot is a function. It leads to the question of market value. Every asset that you buy that from a vertically integrated company like JWB is priced at market value. So any concerns that you have about price per square foot, those are easily answered by looking at the other homes in the surrounding neighborhoods that are recently selling. And that's what any appraiser would do. And all of these properties are priced to appraise. So if you have some specific questions about that, that's pretty easy to answer as far as the price per square foot question. But overall, I think price per square foot is it's not something I pay a whole lot of attention to when I'm making a decision here. I need to make sure I'm paying market value. So yeah, I guess I need to know that. But the bigger question is, what's your IRR? Do you have the ability to benefit in multiple ways? Turning equities into income is a big conversation here. So you can do that whether you're buying it with financing in place or if you're buying it with cash, capital preservation. Those are the things that make this special.
So when I think about Sam's question and I hear your response, I'm hearing kind of like 2 different things. One is the asset price as an investment. What makes it special is, of course, this is a class that is outperforming everything else in good times and the only one performing in bad times often enough. And the level at which it's performing, it makes it special. And to think of an investment from that standpoint, right? Like not like what's the dollar amount you're investing, but what are you getting for the amount that you're investing, right? Then I think the other side of Sam's questions, which I think is where he was headed, is the price of a house being, what did you say, $182 per square foot in this area of Jacksonville. I think he is saying that he thinks that that's a high square foot price for that area of Jacksonville, just looking at the real estate market. Sam, what I would like to know is where you're getting your assumptions from, so that way that we can compare that. But like, maybe you can tell Sam where you get your assumptions from.
Yeah, it's from homes that are selling in that area. So we are completely locked into that neighborhood, and we get to see the homes that are selling, beyond the clients that purchase through JWB, just on the open market. And these are the functions of what a typical property appraisal are. And so for all of our properties get purchased with conventional financing, that's a requirement. So the vast majority of properties are going to have an appraisal either way. And that would be a third-party independent appraiser. And it's going to ask the same questions that Sam's asking. It's going to say, all right, well, $182 price per square foot. How does that stack up with the price per square foot of other homes in a very short radius that have sold recently? And so it becomes less emotional. Hopefully, if the appraiser's doing their job well, it becomes less emotional and more objective. You just simply see what else is selling right around there. And you look and say, okay, well, what's the purchase price? How many square feet? What's the price per square foot? They make adjustments based on it being new construction or having a garage, yada, yada, yada. And, vast majority of, those appraisals come back without any question on the value. Every once in a while you get a low appraisal, but, it's almost without exception that we get low appraisals, and you're justified right there for your value.
There you go. So you're saying basically if I was a young family moving to Jacksonville and I wanted to buy a house next door to this one that looked exactly like this one, this was what the house would cost.
100%.
Yeah. So I guess that's it. So I don't know if Sam, and I'm trying to think from like, my role is to think as the consumer, because I'm the uneducated one and Gregg's the expert here. But I would think that maybe you're in your headspace. All right, he says he's got it, but like I think it's I came from Miami where prices shot up real quick, and I remember like while that was happening, there was all these neighborhoods that, like Little Havana, for example, that's like a cool neighborhood right now and people want to live in. When I was a kid, nobody wanted to live there, right? Or like at least not anybody I knew wanted to live there.
Right.
And I remember when it started like going up, people would be like, yeah, man, you can pick up a house in Little Havana for $300K while everything else in Miami is like $500,000. And they're like, yeah, but are you going to pay $300K for Little Havana because for like a 2-1 bungalow?
Yeah.
And like that would anchor their expectation that way.
Right.
And yet people that did buy nowadays, those things are worth like $700,000, right?
Yeah.
So I think it's just kind of like keeping up with the market, and in a market that's rapidly appreciated like Jacksonville has.
Yeah.
I think there's probably these like lingering anchoring expectations of, yeah, but at 182 square foot, like 5 years ago, that's nuts,
Yeah.
but like right now, that's just the price.
Yeah. I think that's real,
Yeah.
right? It's always good to make sure you're buying at market value. There are other turnkey providers out there that sell properties above market value. So it's a really good question, right? To make sure you're paying market value for the home. Yeah. So appreciate the question. Sam, I'd love to know where you're from. Are you from Jacksonville, or another mentality is, typically realtors pay a lot of attention to price per square foot. So when I get a question about price per square foot, I would say majority of the time it's from somebody who's a real estate professional in one way, shape, or form. So Sam, tell us a little bit more about your background. We would love to know.
From where you're from, bro. Jamlando.
Jamlando. All right. Where in Jamlando? I grew up in Lake Mary. So.
Orlando. That's the old 102 Jams inside joke, in case anybody's not an Orlando insider. I used to get 102 Jams when I was at UF. Anyways, Michael Santorios has question number 2. What about for cash buyers? Closing costs on a cash purchase are typically $1,500. Your Excel shows $1,500, not $3,000 credit.
We got you covered, Michael. If you're buying with cash, the incentive package does not change. Those 2% of seller concessions can be used in a number of different ways. We are using for a finance property, we're using those to buy down your interest rate, because that's the best thing to be doing right now. In theory, you could use that 2% of seller concessions in any way you wanted. If you chose just to receive that 2% of seller concessions as a reduction of your down payment, in theory, you could do that. Your interest rate would be slightly higher. And so the way that relates to a cash purchase is, if there's no loan in place, there's no loan to buy down the rate on. So you just get that in the form of a reduction of capital out of pocket. So either way, cash or finance, the same incentive package applies.
This is a great question from Gerard Wendling. Hey, gentlemen, can a solo 401k use the ARM product?
There are different products for your non-recourse loans. In fact, we just had an updated loan package for one or both of our non-recourse loan providers. I don't remember exactly if there's an ARM part of it. Gerard, I would really encourage you to reach out to your portfolio manager. I know we were just circulating the terms there. They changed slightly, like there might be some opportunity to do an interest-only product. And so it's a little bit different. You wouldn't do a 7-1 ARM there, but there's some other things that you can do specifically for the non-recourse products. And in order to get a loan for your 401k or your solo 401k, you would need a non-recourse product. So definitely something to look into. Reach out to the team. We'll get you the information on it.
Phenomenal question from Bill Green here. I can't wait to get into this one. Bill Green from the sunny mountains of Colorado asked, so theoretically, if I bring my estimated $220K cash from my Colorado condo sale to your table, I could likely buy and finance 3 Jacksonville properties that bring monthly positive cash flow, or more than 3, maybe.
Love it. Love me some Bill Green. Huh?
Bill Green's rising up the chart. He's just climbing up like the Rockies over here with
he's the mountain man. Bill Green.
Bill Green, the mountain man.
Bill Green, the mountain man, right?
All right. Rocky Mountain High, Bill Green.
Oh man, this is so good. Bill, I just think you're just on a great path, man. And this is a path that a number of folks in this community have gone down. So if anybody has been that same kind of realization that Bill's having right here and saying, listen, I've got a pile of cash. It might be in the stock market. It might be in a property in another market that's just not performing the same way. And, could I take that pile of cash and turn that into multiple rental properties in Jacksonville that are going to pay me 5 ways? The answer is absolutely yes. So typically for your down payments for a conventionally financed property, you're looking somewhere around $75,000. For this property, I think it's a little bit less. It's probably a little bit less than that. Let's see $62,000 total out of pocket. So if there were 4 properties like this, which, Bill, there are 4 properties that are very much like this in our inventory right now.
Yeah.
In theory, you could take that $220,000 and turn that into 4 assets that are paying you positive cash flow, that are decreasing your tax burden, that your principal is getting paid down by your resident, that are going to appreciate over the long haul in Jacksonville, and that are going to help you hedge against inflation. And you got it, man. 3 or 4 at least.
Opportunity to just talk a little bit about 1031 exchange, make sure Bill's not missing anything here.
Yeah. So 1031 exchange is a way, that you can take the profits that you are selling a previous property, like this one potentially in Colorado. And if you structure this the right way, which we're happy to help you do, you don't have to pay the taxes on the sale at that moment. You can defer the tax burden of that sale, which might probably saves you at least 20% that you don't have to pay in long-term capital gains taxes. So much that can be done, Bill. And we've been able to, I've seen your name a couple of times. I've seen you in the group. I know my team has chatted with you, Bill. We just really enjoy the opportunity to work with you. I would say fire that conversation back up. And you might already be in conversation with my team, but let's specifically see if we can put this plan in place, maybe even think about a 1031 and let you take advantage of this incentive here.
Things that I've heard you say in the past about the 1031 is that you have to have the properties identified. So like before you sell the condo, you want to talk to JWB and have that identified and get that conversation going, right?
100%.
Yeah, because it's like Bill, we should send you the 1031 show that we had, right?
Yeah.
Like they went over all these things of like, you got to have a certain amount of days, you got to have a middle person in place already named. And in order to do that, you got to kind of like be real proactive about it, right?
100%.
Cool. Madison, I don't know if you can look up the 1031 show to send it to him. Awesome. That's why she's Madison the Magnificent. Lee, the MVP Bishop says, hey, Greg, can you go over the rent range starting at 1377 and goes to 1452?
Yeah, absolutely. We just look at this the same from Sam's question, understanding like, how do we know what price per square foot is? How do we know what market value for that neighborhood is? The same thing that we do for evaluating estimated rent ranges. And then
where do I go for this?
Well, you can just go back to the summary tab.
Okie dokie.
Yeah. So what Lee's referencing there is row 24 estimated rent range of 1377 to 1452. So we take a look at what things are renting out in that neighborhood. And, we got a ton of comparable rents because we stick to 4 neighborhoods in Jacksonville. So we basically dominate this neighborhood 32254 here on, what's the name of this road again?
Susquehanna.
Yeah, we dominate that road and the neighborhood there. So we have all of these different, homes that are rented in a very short radius. And then we just look at those and that's when we understand what they're rented for. And that's how we develop our estimated rent range. This one is already rented, which is fantastic. So the rents on this one, the average rents of $14.15, we do that when we have multiple year leases. So this is actually an average of the first and the second year rents. That's how you get that 14.15. And then I went and I looked in the second year, because we do get rent escalation. So the client who owns this one in the second year, the rent actually goes up to 14.52, which is what we put the high end of the estimated rent range, because we know that we're going to get that in year 2.
Sweet. All right, there you go, Lee. Great question, buddy. And Aaron O'Neill. Into the lines, asking questions in the Q&A.
What do you know?
What do you know? She's asking, what neighborhood is this zip code in? 32254.
Yeah, so this is specifically, it's called the Paxton neighborhood, which is very similar to it's a part of our Jacksonville North Side neighborhood. Okay. Yeah, so just north of I-10, but a neighborhood that we've invested in hundreds of rental properties ourselves and our clients have over the years. So it's one of our 4 core neighborhoods.
There you go. Bill Paxton, center for the 96 Bulls, something like that.
John Paxton. Good pull. You're lucky that I know the 96 Bulls, by the way. You've been on a limb there.
I went far out on a limb there, buddy. Yeah.
Isn't he like an actor, Bill
Paxton? Bill Paxton. That's the actor, Bill Paxton. Yeah. Okay. He was in Apollo 13, I believe.
Yeah, there we go. We love that guy. Okay.
All right. Paxton neighborhood. Good people. Good people.
Good people.
GC, anything else that we want to talk about? It's 121, man. I think this was a very meat and potatoes property of the week getting into the incentive, man. I thought you did a great job with it.
Well, thank you, man. Our community did a great job. I want to recognize Sam for asking great questions, for Bill for, not just asking a question, but kind of putting the whole theory together and sharing that with the group. I haven't been able to see the chat because you've been hogging it on your screen all day, but I'm sure everybody showed him some love. So
Yeah.
we appreciate all of you just
Aaron O'Neill getting into the Q&A, into the light, from
into the light,
to the Q&A,
into the light.
Yeah, man.
This is just the progression that we hope we're all on here. We hope we get more people into the show, into this community, the right people though, right? Yeah. We don't need to,
not average people.
We don't need to, have these ridiculous numbers.
Well, Noah Rondari's in the house. He hadn't checked in yet. He just said, thank you all.
There we go. All right. It's the man that everybody knows.
Everybody knows.
So, and then when you get here, we want you to take advantage of it. We want you to be a part of the community. It just seems like we're kind of seeing that progression with more folks showing up, saying hello, asking great questions. This is, that's how it's all drawn up.
My favorite thing is that the 3 folks that have bought since the thing was announced are all community members.
I know.
Like
that's special.
That really just puts the jelly right in my donut, makes it extra delicious, my friend. So we got a big show next week, people. Speaking of community stuff, speaking of big pools, speaking of vertical integration, you want to talk about who's coming on the show next week?
Yeah, just a little somewhat of an important, the mayor of Jacksonville.
The mayor, the chief executive of Jacksonville.
The mayor, Lenny Curry, is going to be joining us on the show. It's funny when we ask folks what were the best shows of the Not Your Average Investor show. It's not the show where, Gregg taught something. It's not the show where Pablo and I were just yucking it up. I mean, sure, that's important. We want to do that. But always you guys are saying, hey, listen, I love what we do at JWB, but I want to hear from some of the movers and shakers in Jacksonville. There is not a bigger mover and shaker than our mayor, Lenny Curry, an incredible guy. He has done incredible things in his 8 years of leadership here in Jacksonville, and so many things that we have to say thank you to him for, and really pick his brain on how he has created this positive momentum that we have in Jacksonville, and created an environment where companies like JWB can jump in and push the ball forward. So we're excited to have him here, even hopefully in studio. We're not sure if he's going to be in studio yet.
We're not sure yet.
We hope he's in studio.
Fingers crossed. One of the things talking to his team was, this is his last year, right? He's on his way out. He just got his final budget approved.
Right.
And I think just going through like the journey of like what he stepped into to what the city is now, to what, he thinks needs to be invested in, just like we're doing, right? I think is a really, really great conversation.
Yeah.
And I don't know if you know, but around here, we always say that, a lot of cities got mayors, some got Honda Civics, some got BMWs. We got Lamborghinis. So Lenny Curry, he's the real deal out here. I just want to thank the community, man. This is a great show, great questions, great chat. Love the new name, Sam. Welcome to the community, man. Hope we see you around some more. And
could also be a lady.
Could also.
You're really good at screwing that up.
I've learned that lesson. I've learned that lesson. But we just never take it for granted that it's like the middle of a Thursday, a work day, and you're here for an hour and asking these great questions and making our job easier and allowing us to share this message with you. So thank you for being here. GC, I'll give you the last word.
Just you guys make this super special for us each and every day. It's so fun to wake up on a Tuesday or on a Thursday and just think that we get to spend this time together with everybody, and you guys make it special. So you know what? I was especially impressed when we looked at the number of attendees and who attended the show on Monday, which was the client only call. Those same numbers and those same people came back on Tuesday. Yeah. And it wasn't because they were here to learn anything different, right? Maybe a little bit of reinforcement of some of the points, but they came for all of you, right? It's more about this community. It's more about the friendships and the learning that we get from all of you. And we're just so thankful. So thank you guys for making this community what it is and giving Pablo, myself, and Madison such a cool job to do.
Yeah. And hope to see you on Tuesday with the mayor. And until then, if you're going to make these great decisions and preserve capital and turn equities into income and all this great stuff, beat inflation, you just can't think like an average investor. See you next time.